And joining me now to discuss BTC price and other Bitcoin news is our Week in Review panel with CoinDesk Managing Editor of Technology, Christy Harkin in Toronto, and Managing Editor of Markets, Brad Count in Austin. Welcome, Brad and Christy. Good to see you.
Hey, Christine. Happy Friday.
Thanks, Christine.
Happy Friday.
Happy Friday.
So Bitcoin on a tear, Brad. It briefly breached 43,000, as I mentioned before. What is the catalyst behind this?
Not a lot of fundamentals, to be honest. I mean, that we can point to. We had that jobs report story this morning, and much bigger number than people were expecting. Theoretically, that would imply the Fed would move sooner rather than later to tighten monetary policy. So it seems like that's kind of the opposite direction of what we're seeing today. I think it's kind of a market that seems like it wants to go up. We had that 10-day rally that ran through, I think it was last Saturday, and then we had a little mini sell-off over the next few days. And we're now up for the past 3 days, and they've been pretty strong daily consecutive moves. As you pointed out, the technical charts sort of showed that contracting triangle, and we've broken above that. So it looks like a pretty strong market. You know, there's various indications of demand and people, trying to figure out where things go from here. But yeah, it's just its bullishness has returned to this market.
Yeah, and if we look at these charts, we're seeing a lot of risk on activity. Do you think the London hard fork had anything to do with the bounce we're seeing in the crypto markets right now?
Well, I mean, it's really interesting when you're looking at Bitcoin in the sense that, Bitcoin is known for having this, gradually decreasing supply growth with the halvings that take place every 4 years. And that is basically what kind of happened with this Ethereum hard fork, with the London hard fork of when the fees are being burned and that takes out some of the supply. It kind of resembles a Bitcoin halving in some way. So,
Christy,
but that's been
accurate?
good.
I've seen these comparisons that burning of ETH is similar to a Bitcoin halving. Is that the case?
No. So what I would argue respectfully here is that it's not when Bitcoin has a supply cap. Ether does not. We know there are going to be 21 million Bitcoins. We also know that they are going to be emitted into the ecosystem in a controlled, entirely predictable manner every 10 minutes or so. And every 4 years, yes, we get the halving, but we're not burning half our Bitcoin every 4 years. We're just not releasing them as quickly as we used to in the past. Whereas Ethereum is burning. They are destroying coins. They're not slowing down production. They're saying we're going to keep mining the same number of Bitcoins, and there's going to be an infinite supply of those Bitcoins, but to create a kind of a balance in supply, we're going to destroy part of what we are putting out there. And even that is not predictable. It depends, it's a percentage of fees, which are themselves not predictable. So we don't know in 10 years how much Ether there's going to be in the supply. Whereas we do know how many Bitcoins there are going to be that have been created over time, and we're going to know exactly when that supply is going to end. And yeah, that is when we talk about it being priced in at the halvings. It's because we knew in advance that the supply was going to decrease in this slow, steady, predictable, algorithmically determined, unalterable way. And so I mean, yes, it does kind of do what the halving does in terms of, maintaining a supply cap of sorts, but it really is, I think, technically quite different.
Mm-hmm. All right. Oh, I understand, but
You want me
people
to
have the
respond to
impression
that?
yeah,
Go ahead, Brad. You do
Well,
that,
I was
Brad.
going to say I agree. I agree with Christy in the sense that she's, it's absolutely true that Bitcoin's supply curve is known, like until the very end, until we get to 21 million coins. That is absolutely true. And the way that the Ethereum fees are working now and the burns, totally unpredictable. I mean, maybe somebody can model it, but you can't really know exactly how it's going to go. On the other hand, what I was referring to is the Ethereum blockchain was basically producing, 2 ETH of mining rewards per block, and the amount they're burning is like 40% of that. So if you sort of assume it's a 40% reduction in the supply issuance rate, it's almost like a 50% reduction. I think that's what I was kind of saying. It was kind of like a halving in that sense.
Yeah.
Does that work for you, Christy?
It's an answer to the halving, but it's not quite the same thing.
Fair enough. Taking a look at the options, Brad, that's pretty interesting because they're pricing them pretty high.
It's a speculative market. Omkar wrote a story saying that people are buying call options at 140,000, 200,000 for the end of this year. I mean, that would be a pretty big rally. And it would take the market cap up to almost like $3 trillion or something. But yeah, it's a speculative market and people take all kinds of risks, and maybe it could happen, or maybe people just, it's just a lottery ticket.
Yeah. Another news story this week was about Bitcoin ATMs, and I didn't report on this one, Christy, so this one's all yours.
Well, over the past couple of weeks, Bitcoin ATMs have been in the news again. It's funny, it feels very throwbacky to me. So Coin ATM Radar published a report that the number of Bitcoin ATMs has jumped something like 70% already this year. CoinDesk reported also, not this week, but the week before, I believe, that that Bitcoin Depot has joined Circle K convenience stores to install over 6,000 of their Bitcoin kiosks across North America by the end of the year. Now, Bitcoin ATMs have been around a long time. The first one was installed in Vancouver back in 2013, and there's now something like 24,000 all around the world, mostly in the US. Actually, 93% of ATMs are in North America, and nearly 5% are in Europe, according to the report, as you can see on the chart. Bitcoin ATMs feel familiar to us. We're all familiar with ATMs. They're super easy to use. You put your money in, you get something out, a paper wallet with Bitcoin on it. You can hold it in your hand, sort of. It takes a few minutes, depending on KYC requirements. And in some jurisdictions around the world, you don't even have KYC requirements. So it's easy to imagine someone popping around to the Circle K, picking up a gallon of milk, a lottery ticket, and oh, hey, let's try getting some of that Bitcoin everyone's talking about. But the thing with these ATMs is that they charge a hefty premium, something like 20, 30, 35%. And it's hard to imagine why anybody would actually do that, especially in North America where there are so many decent exchange options. I mean, back in 2013, exchanges were still evolving, and buying and selling Bitcoin was a lot trickier for newbies than it is today. I mean, Mt. Gox was still the biggest name out there, and after it crashed, it's understandable that people might have preferred to stay away from exchanges, and certainly there are plenty of places in the world where that's the case. But if you can't send fiat from a bank account or a credit card, sure, ATMs are really handy. Or if you're intimidated by the whole set up a wallet and get on an exchange process, it's kind of acts like the Bitcoin version of a check cashing service. You're paying a premium for convenience and accessibility. And I get it if you're in an area that's unbanked, or if you yourself are unbanked in a otherwise bankable area, but it's a lot of money to spend for the convenience. But people are doing it. The profits are going up for these ATM operators. So we'll see where that goes.
Interesting. Okay. And other news that I've been watching this week includes Uruguay, a leading lawmaker from a leading party there, is introducing a bill that could make Bitcoin they could accept payments as in Bitcoin in Uruguay coming forward. So that's an interesting addition to the El Salvador Bitcoin law that it will go into effect in September. Also, JPMorgan launching an in-house Bitcoin fund for private bank clients, which has some significant spread because it could mean more people buying into Bitcoin, people with big treasure chests able to buy up and stake, buy up a portion of Bitcoin.
Yeah, absolutely. I mean, that was the great scoop by Danny Nelson earlier this week, CoinDesk's Danny Nelson. And, you know, I mean, when Galen Moore was on this show a month or so ago, I mean, he would repeatedly talk about signs of institutional demand as really driving Bitcoin. And those may have slowed down a little bit. In fact, we even got kind of some news from SEC Chair Gary Gensler this week that maybe, you know, a lot of the existing filed Bitcoin ETF proposals are probably not going to be approved under their current form. So yeah, it was great, you know, for the Bitcoin bulls to get this new sign from JPMorgan.
It was a major turnaround of, you know, after JPMorgan CEO Jamie Dimon has been saying Bitcoin is a fraud, and, you know, you never invest in Bitcoin, and now the company that he heads is launching an in-house Bitcoin fund. So interesting turn of events.